So one of the key hurdles that you find in trying to buy apartment complexes, and we've got a subject matter expert with us today in the form of Mr. Chad Green. It's like, how do you qualify for these loans if you have not bought any real estate or any high value real estate, if you will, right? If you haven't bought anything in the $3 million, $5 million range, and the largest purchase you've ever made is $300,000, and you go to a bank and say, now I want to go buy this $10 million property, you're gonna run into a problem, right? And that is, why would any bank loan you that amount of money? How do you do that? And if you've had situations like I have, sometimes you go out and say, well, I'm going to get the money from private investors to do this deal. So I don't necessarily need all the down payment myself. This is what we do here, the syndication model. And if you are going to be raising private equity, sometimes you might run into a gap. You need $1 million. You were only able to raise $500,000. What do you do in that gap? And you got 2 weeks to close or a month or so to close. Today, we're going to be talking about that. So Sharon from Maryland and Lee from Charlotte, North Carolina, and Tom come from El Paso, and Brady from Hampton, Virginia. That's what we're going to get into today. And so who am I and why am I talking to you? Well, my name is Jason Stubblefield. For those who don't know me, I have been investing in apartment complexes since 2016. I had to think about that myself. And just let me give you a brief intro before we get going here. So I put together this meetup years ago. Used to be in person. We would all come together. Now it went virtual. COVID smacked us in the face and all of that. But what you're looking at now on the screen, this is my website, snscapitalpartners.com. That's like Nancy Sam capitalpartners.com. Soon to be rebranded. Hopefully by next week, this will all be something new and different and sexier, you know what I mean? So y'all, I know y'all are waiting. You can't wait to see my new website. Stand tight, hang on. I'll have it for you next week. But you can check out more about investors who have invested with us, see a little bit more about me, what I'm doing. If you are on the passive investor side of the game, if you come over here to the invest tab, you can hear about the deals that we do. Fortunately, the team did a great job. We closed on a property last week. If you did not hear about that deal and you're a passive investor, you want to hear about our future deals, you just click join now. That'll put you into our world after you fill out this brief form. And that way you can hear about future deals and see if they work for you. Because I think they're pretty sweet. So other than that, I'll go ahead and stop that and accepting the remainder of people into the group, and we'll go ahead and get started. So today we've got someone that I have spoken with before, and you know what? First time I met Ethan, who's going to be speaking to us today, it was discussing the deal and what he could do with the deal. So he's not just somebody who talks, and I try to not have anybody who's just purely a talker come on here, but Ethan is somebody who is doing it, who's in the business, and has really created his business around the services that he offers and helping solving these problems. So you definitely want to be listening to this if you're looking for a key principle to help you fund your deals. If you may run into funding gaps, you don't want to miss this out. Yeah, so for everybody else, like how I met Ethan is that there was a deal that was going on, and one of the students was looking at it, and he came to me and said, "Hey, I've got a great guy who's going to help with doing all this." So we leverage, right? We understand that finding a key principle is something that you needed to do, and that's what led me to Ethan. Say, "Hey, you might want to talk to him." And we hopped on to discuss a deal and how it might work, how we might be able to work together. And that's sort of my introduction. And since then, I've seen Ethan on other podcasts. I've seen him as part of multiple networks that he's done. So without further ado, I'm going to go ahead and Ethan, if you can unmute yourself and introduce yourself to the group, we'll get going, my man.
Jason, thank you so much for having me on. And yeah, we met about 18 months ago with some other partners looking at a deal, I think, in Georgia. So here's a little bit of background about me. I've been a corporate lawyer for about 17 years. I graduated from Columbia Law School in 2006 when I was 22 years old. So I was On the younger side, I basically skipped 3 grades during school. And the first job I had was as a corporate lawyer at a big firm in Manhattan, New York. We did large mergers and acquisitions. I did that for several years, and then I moved to Houston, Texas about 10 years ago. About 9 years ago, I got into real estate. And specifically, the reason I got into real estate was even though the job that I had paid me a lot of money, it was between 300 to 400,000 W-2 per year. It was a super difficult job. And if you got promoted, your job actually generally got harder. So I wasn't super interested in continuing that journey. There were a lot of barriers to getting promoted anyways. So I just kept Googling, what do I need to do to not have to work at this job? And really 2 things showed up in Google. One was real estate investing, and the other was franchising. So I looked into franchises for quite a while, spoke to a bunch of these people that charge you money to find you the right franchise. And all the ones that they basically showed me and all the ones I looked at were basically buying a terrible job. So I said, I already have a terrible job. Why do I need to go buy one? And my terrible job pays me 300 to 400K a year. Like, why would I go spend 300 to 400K to buy a crappy job? So I went more into real estate investing, and specifically I looked, I watched like every podcast that Bigger Pockets had at the time, which was about 100. I read every article, I subscribed to a bunch of stuff. And after I did my due diligence and learning about real estate, I decided I was going to be a hard money lender. So I've done about 400 to 500 hard money loans here in the Houston, Texas area for people fixing and flipping houses. And then about 3 years ago, one of my friends just straight up asked me, hey, Ethan, you keep millions of dollars in your life insurance policies as liquidity. How come you haven't signed on loans as a key principal or a loan guarantor? And I was just confused, and I've never heard of it before. And then once he explained it to me, I was like, yeah, that's totally true. Why have I not been doing that? So that's kind of how I got started. So I've been doing that for about 2 years. And then people just generally remembered that I keep a lot of liquidity. So about a year ago, somebody said, hey, Ethan, I don't need you to sign on this loan. I already have it all set, but I'm missing $2 million. I'm buying a 25 million apartment building in Phoenix. I needed to raise 10 million of limited partnership money, but I only raised 8 million. I'm short 2 million. I've got 500K of earnest money at risk. I can't get an extension from the seller. Can you lend me $2 million and I'll pay you back post closing, and I'll just pay you back when I raise money post closing. So I did that, and then since then I've done several others just like that.
Yeah, awesome. Yeah, and that is such a huge need, because I've been there before. You get to close the table. It's like, all right, you got two choices, right? You either get an extension, or you lose earnest money, or you find somebody like you and what you're able to step into. So with that, are you doing slides, or we're just talking?
Oh, I don't have any slides.
You say what?
I don't have any slides.
All right, awesome. Love it. So then I get to ask the questions, ask you the questions that I want to ask.
Absolutely.
Are you still doing hard money loans?
No, I basically refer all of them out.
Okay. All right. So you still got the business source and you just refer them out. Why did you choose to change from going with hard money into just doing the key principal and gap funding?
Yeah, so I charge significantly more for gap funding than I can on a first lien deed of trust hard money loan. Everybody and their brother and their mother is in hard money lending already, so I have no comparative or competitive advantage vis-a-vis any of the other local hard money lenders here in town.
All right, understood. And then when it comes, can you just walk through key principles? So I know some people may be unfamiliar, but if they met you and they said, hey, Ethan, I want to go buy this property, but I don't necessarily have liquidity net worth, what do you do for them, and why do they need to be connected with you?
Yeah, absolutely. So I'll just walk this through. So let's use that same Phoenix, Arizona deal that I keep talking about, because it's a great example. So on that deal, purchase price was 25 million. Freddie Mac loan, 15 million. Limited partnership raise was 10 million. They raised 8. They couldn't raise the remaining 2 million in time. So I lent it to them. However, let's just kind of take one step back. Let's say they didn't have a key principal or a loan guarantor on the deal before. Let's say we're, fast rewind 4 months when they were first doing the deal. So lenders are going to require that the lead sponsors have net worth. So 3 things: net worth that exceeds the loan amount, liquidity that exceeds either 10% of the principal amount of the loan or the equivalent of 1 year's of interest reserves, and 3, experience in doing that asset class. So you might need me for all 3. So you might not have enough experience, so you need to bring me or somebody like me on that has signed on loans before for projects that are similar. You might have, in our example, 15 million was the loan amount. So you might have 14.99 million of net worth. You know what? Too bad. That doesn't qualify. You need to have at least 15. So in that case, you need to bring on someone else to move you over the edge. And then let's say you have 15.01 million of net worth. That's also great. So you check the box on net worth, but you need 10% of the loan liquid. So you need 1.5 million liquid that you can show to the lender. So if you've got 15.01 net worth and you have 1.49 million of liquidity, you don't qualify. So you have to bring on somebody else. So I kind of am that somebody else that can basically check all 3 or any combination of those 3 boxes. So I hold quite a lot of liquidity in general. I have relatively high net worth, and I've been doing this a decent amount. So I have a lot of experience.
Awesome. And so that's exactly what we try to accomplish here with this group. A couple of weeks ago, we talked about teams, building your team. People, they'll talk to me and say, hey, I'm about to go out. I'm going to start a multifamily. I'm going to buy a $10 million piece of real estate. And I'm like, no, you're not by yourself. You need to have connections with somebody else to help you qualify for the liquidity, net worth, and experience factor, like you just mentioned. So for somebody who may want to reach out to you, what are you looking for from them before you would decide, hey, I'm willing to sign on this loan with you to help you meet that criteria?
Yeah, so typically I look at a few different things. Number one is experience and track record. So unlike the stock market, prior experience and prior track record is generally a pretty good indicator of future performance. So if you've been doing this before, I want to look at your projects before, how you're doing, if you exited. If you haven't really done this before, I would look at other related experience. So if you've got other real estate experience that you've done, or if maybe you come from a job that's real estate adjacent, like you're a broker or you're a property and casualty salesman, so you're kind of close to real estate, so you generally understand it, but you might not have done it yourself as a principal. I'd go look at that. And then number 2, which just overall character and personality. So generally, I think that there's about 20% of the population that is just the bad fit for me. Just will never be a good fit. They just have certain personality quirks, and there's things that they won't like about my personality. And then about 60% of the population is generally acceptable. So we'll be able to get along fine. We might not be best friends. And then there's about 20% that would be really good fits with me. So some examples are people with advanced education that came from a high stress corporate background. I usually am a really good fit with those people just because I came from that exact same background. I'm not saying that everybody that's a good fit has to have that background, but I've just found that one is a really good fit for me, and vice versa. So what am I specifically talking about here? So I worked since I was 22 as a corporate lawyer in very high stress situations where we were expected to respond to things very quickly. So, as when people want to call me on the weekend, unless I'm busy, I just pick up. If people email me, I email them back. If people text me, I text them back. If people call me, I call them back. That's just how I am. And I know all of you on this call, on this webinar or Facebook Live, all of you have people like this in your lives where they're terrible at responding. Those people are generally going to be bad fits for me. So I don't really care how good they are at what they do. It's just going to be a bad personality fit. So most likely that's not going to work.
Yeah, I love that as a strategy, right? Because it sounds like you have like a two-pronged approach. One, you want the fact that they have the skills, the knowledge, some sort of experience to make you feel comfortable to even work with them. And two, the personality of the person that you're dealing with. Are you going to ask them for paperwork or try to call them because y'all both signed on a $10 million real estate loan and now they're taking a week to respond to you? I get that 100%. And that's what I would say for those who are looking to get started, right? One recommendation is to start with something that's small that you can do on your own, or to be able to partner with somebody else who has some sort of experience and connection. Because if you want to reach out to Ethan and you're like, I haven't done anything, then you might be able to say, well, I've got a mentor who's done a lot, or I've got a partner on my team who's done some deals before. But nobody wants to take a risk on somebody on their first deal, especially when the numbers are relatively large. Ethan, would you agree with that?
Absolutely. It's almost always, it's great to have people that are, mentees or students of you, because at least they've gone through the program and they can call you for advice and you've done it. So, I always like it when people came out of some sort of training group. I'm not saying that's necessary, but if they came out of a good training group, that's usually value add, especially if they can partner with more experienced people in that network or with their mentor.
Yeah, absolutely. And so you'll sign on the loan, and let's talk about numbers, right? Because obviously you're not going to do that for no reason. So if somebody reaches to you and say they want you to help them qualify for this loan, how do you do a split with them? How do you split the equity on that deal?
Yeah, so it's relatively flexible. So we've done it 3 different ways. So we've done it sometimes as a pure cash fee. This is usually in situations where the borrower or the sponsor just really believes in their deal. It's going to be a home run, slam dunk, grand slam, touchdown. So they don't want to give up a lot of equity in the deal. So they'd rather just pay me an upfront fee, and then I don't get the equity in the deal. And then I have the opposite, which is, hey, it's too hard to raise money, or we don't want to raise that much money. We want to raise the minimum. So I'm just going to pay you in as much general partnership shares as possible. And then sometimes we do a combination of the two. So on some deals, they build into their pro forma and their sources and uses, like a small fee for signing the loan. And then I also get equity in the deal, GP shares. So each situation is a little bit different. And then in general, for loans that are non-recourse, there'll be kind of a certain price. And then for loans that are full recourse, and I'll make a distinction here. So a full recourse loan means that regardless of what happens, so let's say on that $15 million loan that I keep coming back to as our prototypical example, if that was a full recourse loan and we sold the property for $14.99 million, our investors lost all of their money, and we owe the bank $1, that means the bank can come after us for that dollar, and they're going to get it from us. It doesn't matter what happened. It doesn't matter if it was our fault. We're just really bad at what we do. We're just truly dumb. It doesn't matter if we are the smartest guys in the world and, interest rates just went to 100% and there was just no way to operate that thing. It just doesn't matter. The bank could get that last dollar from us. Whereas on a non-recourse loan with standard bad boy carve-outs only, in that same example, if we sold the building for $14.99 million and we had a deficiency of $1, the bank actually cannot come back and sue us and get $1 from us unless we committed some sort of severe non-compliance or fraudulent activity. So severe non-compliance is, not delivering financial statements in time, not renewing insurance, mixing, commingling funds that were not allowed, or just actually engaging in some sort of weird fraud thing. So if we just operated like normal people and we didn't engage in fraud, then the bank actually has to eat that dollar loss. They can't actually come back to us for it. However, it still hurts us because every time we apply for a loan, one of the questions is, have you ever been foreclosed on? Have you ever given money? Have you ever given property back to the lender? Have you ever had a deficiency when you sold the property? So once you start clicking yes on all of those, you're going to be quickly disqualified from signing loans.
Yep. You mean the deal needs to work even if it's non-recourse. And I'll say that you are a little bit distinct in the fact that most people don't like signing on recourse at all. You have the ability to do both. You'll do recourse and non-recourse. And that's the importance of establishing the relationship before you have the deal, so you know that who you can reach out to. Because if you have a partner that says, I only want to do non-recourse loans, then you can't really reach out to them if you're going to a lender trying to say that I want to get recourse debt on this property. Ethan, with that, are your fees the same whether it's recourse or non-recourse, or does that change? Does it matter?
It does. Yeah, it does change. So I also prefer non-recourse loans, but I'm willing to consider recourse loans, and I have done recourse loans. The recourse loans tend to be in Houston, Texas, where I understand the market a lot better, and where worst case, if something truly bad happened, I would be okay coming in and operating it myself. And I think I'd be generally open to recourse loans in Texas, just generally, and then just in certain situations. And yes, I do charge more if it's a recourse loan versus if it's a non-recourse loan. Number one, because like I described before, the risk is, structurally a little bit higher, but also as when I apply for new loans and I have a lot of recourse loans, the lenders and the brokers ask a ton of questions, and it just limits the total amount of loans I can do.
Yeah, no, understandable. And so to make sure I got it like on your splits, somebody could do a flat fee with you. We've done that before, mainly where you write a number into your underwriting, say, all right, that's my guarantor fee, or they could do an equity split. Equity splits, they would more so do if they feel very confident that they can raise the money. Is that what you were saying?
Yeah. So a lot of times, if people are struggling to raise capital, let's say each team is different. Some teams are extremely good at raising money. Some teams are less good at raising money. So if you just pay me a flat fee at closing, that essentially means you have to come up with more money at closing in your sources and uses. So if you're not very good at raising money and that's a struggle for you, then that might be really hard for you. Whereas if you're phenomenal at raising money and you really believe in the deal, it's probably a better deal for you to just pay me a flat fee at closing and then keep all the equity upside yourself.
Yeah, absolutely. Especially if you perform well, and then you gotta look like, oh, I gave away whatever percentage of this deal, and now you got to split. You see that check, you're like, okay, that might be a lot, but hey, do what works, right? The thing of it is just, it's great to be on that side and paying people versus being on the side of not getting the deal done. All right, so tell me a little bit about the situation where you're just doing the gap funding. What do you charge on that? When should somebody reach out to you in order to make that happen?
Yeah, that's a great question. So the kind of the joke answer is I charge extremely high amount of fees and interest, because it's basically a get out of jail type of situation. And a get out of jail situation is going to be a more costly situation. Usually I'm only given a week, max 2 weeks to get everything together and done. So it's a highly stressful short-term transaction. I'm looking for repayments within 6 months. If it's going to be longer than 6 months, I'm not super interested in making the loan. And ideally, it'll be 4 months or less, because like I said, I charge so much in interest and fees. It's not a loan that you can actually afford to take for that long. You should be trying to pay me back as quickly as possible. And as soon as you raise additional money, you should be paying me down to reduce the principal so that you can potentially reduce the fees. Yeah, so on that, I'm really just underwriting the sponsorship team. I want to make sure that they're creditworthy people. they can raise additional money to pay me back. And I also look at their deal just to make sure it's not a crazy deal. So, it's totally normal to see a 16% IRR with a 2.01 equity multiple. If you're coming in at 46 IRR and 4.25 equity multiple, I'm going to need to look into that to make sure you didn't do your math wrong. Or if you come in at, 5% IRR with a 1.45 equity multiple, I'm going to have to say, hey, Jason, man, you're not very good at this. I can buy a CD that pays 5%. You might want to go get a real job.
Yeah.
But if you're just like everybody else, you're kind of in that 20th to 80th percentile of deals and it's normal, then that's totally acceptable to me. I'm just looking for abnormalities.
Gotcha. Gotcha. Yeah, it makes sense, right? You're gonna bet the deal, and my deal's not gonna look like that. But you've probably seen some, so I get it. And like for everybody who may look at Ethan, and if they're not on the call now, they may view it later. And they'll be like, man, he's being all aggressive and taking advantage of people, right? What he's doing is actually creating or incentivizing the behavior that he wants, right? So when you make a loan, if he loans you money at 6%, you're like, well, hell, I can pay this. I might just hold on to his loan indefinitely. But he doesn't want to loan that money out so he can go loan it to somebody else. So there's a high interest rate attached. It's very costly, so that you say, all right, I don't want to keep Ethan's money a second longer than when I need it. So as soon as I raise the money, right, I give it back to him, and that's why it works, right? So just understand that you get your bank financing, you have your investors that you pay, and then you leverage Ethan on a loan like that when you need it if you get in trouble. So I think that is awesome, man. I really think that you've carved out a unique place in the market to be able to play here. And if there's nothing else that you'd like to share, I want to go ahead and just take a couple of questions that came in. Is that cool?
Yeah, let me just make one final comment. So in general, I would view it, so I would switch the mindset slightly. So instead of viewing it as like I'm coming in to take advantage of a situation and lending you money at a super high rate, I'd actually flip it, which is your deal is about to die. Ethan Gao is here to resurrect your deal from the dead and give you an additional up to 6 months to actually raise the funds. That's essentially what I'm doing. So there's two things to think about. Number one is if you really like this deal and you don't want to lose it, then obviously that's valuable right there. And number two is just more mathematics and financial, which is if you got a ton of earnest money hard. So there's been deals I've been involved in where they had 850, one of the deals I worked on, and I made a $6 million loan the same day to save a deal. On that deal, they had $850,000 of earnest money hard at risk. So I could have come in and charged them $849,000, and it would have still been a great deal for them, because instead of losing that money, losing their face and reputation, they could have, it was still a better deal to at least not lose that money, not have to return all the investor money that they already raised, and they still get the upside in the actual deal itself. So I would just shift the mindset a little bit.
Yeah, absolutely. It's better to get a deal done and pay you than to say, hey, it's too expensive or whatever, and not pay you and end up losing the deal and losing earnest money and all that. So I'm with you, man. However you want to choose it, like you incentivize the behavior, but even if you did save a deal, the value that you provide is there, and that's why you should be willing to pay for it. I'm 100% agree, right? You should pay to save your deal, and however you view it, you view it that way. Whether it's he's incentivizing you to get your money back, or whether it's saving your rump because you're about to lose a lot of money, right? You do it.
Yeah.
Okay.
Absolutely.
So a couple questions I want to go in. Typical fees. I know we didn't get that out of you. You said it fluctuates, but you want to speak to that? That's a question that we have from Jim Jeffrey.
Yeah. So on gap loans, the typical fees, it's also a little bit flexible, other than the fact it's going to be very high. So sometimes we charge a flat fee and it's cash, which you can pay at the end of, the maturity, 3 months, 4 months, whatever. Other times we split it. So partially cash fee, and then we get a GP stake in the deal. And then other times we do as a very, very reduced cash fee and then just maximum percentage in deals. So I'll just give some random numbers. So I've taken 10% of the GP before on a deal. I've taken 30% of the GP on a deal before. I've taken cash fees of equivalent to several points a month. So in any case, just know that it's going to be multiple times it's more expensive than a traditional hard money loan with a deed of trust, because we don't have a deed of trust. This is the collateral coverage we have is significantly worse. And hard money lenders won't lend on this because they cannot file a deed of trust or a mortgage on the property. So that's why we're in this niche as a special situations lender, because there's just not other people that are really in this space professionally.
Yep. And then Brandon had a question: what markets do you operate in or are willing to provide gap funding in?
So all markets. I've done it in Tennessee. I've done it in Texas. I've done it in Phoenix. I'm open to basically every market. What I'm really underwriting is making sure that your deal looks normal, so it's not abnormal in a way that doesn't make sense. And then I'm underwriting your ability to pay me back generally by raising money post-closing, right? Because if I lend you $2 million, the question I'm really asking myself is, hey, do I think Jason can go find 10 people with 200K or 20 people with 100K in 3 to 4 months? That's really the question.
Yep. Feasibility of the deal. Can you get your money back? Make sure I'm not missing anything here. Okay. Do you need a business plan or an investor deck to qualify for the funding?
Absolutely. So I don't require people to produce, new documents and formats that is going to take them a lot of time. I just ask that you send me whatever you sent your limited partners and your lenders. So send me your PFS, SREO, tax return, whatever you sent to your lender, and then send me whatever you sent to your limited partners. So your PPM, your pitch deck, your biography, just the usual stuff. You don't have to create anything new for me. Just send me what you have. And then because I've worked on Wall Street for so long, people will send me like 500 pages, and it only takes me like 20 minutes to review it. It's not that hard. Like I can skip all the stuff that doesn't matter.
Yeah. Wall Street's just a different beast when how they even think about stuff. Okay. And then maximum deal. This is from Dash, right? What's the max deal amount for the gap funding?
We don't really have a max. The largest one we've done so far is 6 million, but that is not our max.
Gotcha. Okay. And then question, like, do you lean the membership interest? Like, are you placing a lien in there at all?
Yeah, I generally lean membership interest where I take collateral. Others, whoever asked that question is definitely more advanced. Are they a lawyer?
No, that's Jim. No, okay. He's not a lawyer unless he's got Jim does a lot. I don't know him to be a lawyer though, but he does a lot. He knows what he's doing.
Yeah, we basically are able to give you collateral value for things that nobody else would basically lend you on. That's really what we do. And we're not loan to own. We're not at all interested in taking over your project in some random state. We just want to get paid back our money and our fee in the time that we set. That's all we care about. It would be very annoying and very unprofitable for us to actually have to take something over.
Yep. No, that's good stuff. And I'm glad you brought that up too. Just thing to be aware of is the whole loan to own type of predators that are out there, right?
That's a super hard business. I've done legal work for hedge funds that do distressed deals when I used to work in corporate, and that is just a very hard and stressful way of making money. I'd rather make money in a less stressful and easier way. Just like whenever people pitch me deals, it's like a big turnaround where it's coming out of bankruptcy. I almost automatically pass. Like I don't even look at deals like that. It's just too complicated and too stressful.
Yep. Got it. No, that makes sense, right? And I think what everybody can take away is if you are looking to do a deal and you can go to somebody like Ethan and say, I've got a deal, makes sense, numbers work, it's profitable, I just need help on a loan. I just need, a few months to help raise all the money. You got a great resource to be able to get a deal done. There's no reason for you not to do a deal just because you're missing these pieces and you just figured out how to have a connection with somebody that can make it happen for you. So with that, I got one last question. So I know you mentioned your life insurance policy and doing that. I think that's a great way to do it. Are you just leveraging the personal policy? Did you combine it with someone else? I know you mentioned so how does that work if somebody works with you or your team and the funding of it?
Yeah, so I have been pitched life insurance policies since 2006. So when I first started my first job, there were financial advisors, Northwestern Mutual, AXA, Mass Mutual, et cetera, that would just look for the fresh blood to be posted on the website. They're like, oh, here's like 100 new lawyers that make 200K coming up. Let's try to get them while they're young. So I probably had dozens of free lunches and dinners with people trying to sell me life insurance policies for the past 17 years. I actually really liked life insurance policies as a general asset class because I'm usually pretty conservative by nature, and I prefer low risk or no risk type of investments. So I have always been the right clientele to buy life insurance policies. However, I didn't have a kid until about 11 years ago, so I never bothered buying one. So all I really did was get extremely educated about life insurance and then take free lunches. And then once I had a kid, I moved to Houston. I was like, yeah, it's time to buy. And I bought a policy right away. They didn't even have to sell it to me. So the guy that sold it to me, his name is Luke. We're partners on something else. He was like, Ethan, do you know how hard it is to sell life insurance? Like, you came in and you called and you said you want to buy it, and then you actually did everything on time. It was the fastest policy he'd ever closed, and he was just always surprised because life insurance is very difficult to sell. You have to call people all the time. So anyway, I bought two policies, one on me, one on my wife about 10 years ago. And then when I quit my corporate job about 7 years ago, that same guy, Luke, said, hey, Ethan, you're about to be an entrepreneur. Great. Do you want to know how much money I made selling you the policy? And I said, sure. I Googled it. I know it's a lot. And then he explained it to me and how the whole system works. And I said, this is great. And he hired me onto his team. So I've been a licensed life insurance agent for 7 years. I've got several dozen clients. My client base is relatively concentrated in real estate investors and then lawyers. So about half my clients are real estate investors and half my clients are lawyers. And we really just focus on getting the best life insurance policy for each group. The lawyers tend to not care about being able to borrow from the policies, whereas the real estate investors, all they care about is how to borrow from the policies. And I myself went through this transition. So when I bought my first policies 10 years ago, I didn't care about the borrowing mechanism at all. Luke actually told me the one that I'm buying does not give me enough cash value up front to borrow from. And I just laughed and said, don't worry, I'm not going to borrow. Why would I pay money to borrow money? Like, that's stupid. That's for poor people. And then I became a real estate investor 2 years later. And I said, Luke, I need to borrow as much money from these policies as possible. Borrowing is for rich people. He said, hey, dude, like, do you know what a 180 that was from a couple years ago? So for real estate investors, I put almost all of them into a high early cash value policy. So there's policies out there where if you put in 100K a premium, you can borrow 95K the next day. And that's the best, that exists as of this current moment in terms of maximizing cash value up front. And then for lawyers and doctors and people who don't really care about borrowing, they don't usually go into that policy. They usually take a different type of policy.
Yep. No, that makes sense, man. I appreciate it. Dash Love, will you be provided Ethan's contact? No, we're not doing it. I'm just joking with you. Ethan, how can people get a hold of you, man? And go ahead and tell us, and I'll make sure I put it in the chat here.
Yeah, it's just my email address. So ethangao@gmail.com. So ETHANGAO@gmail.com. I was the first guy with that name that wanted that email, so I got it first.
Nice. All right, good deal. Well, thank you, my man. I appreciate you dropping in. You shared a lot of gems with how to get deals done. Hopefully there are people who will reach out to you because I definitely see the value in everything that you're doing. Appreciate you taking time out of your day, and we'll be in contact, man.
Yeah, appreciate you. Thank you.
So good deal. Good deal. To everybody else, enjoy your weekend. Be the best version of you because it'll make you the happiest. And I'll chat with you next week. Take care.